if you guys are having issues here with BTC and fraudulent stuff, and next thing you know, it'll be crypto is funding terrorism, and all the drug dealers are using crypto and walking around with ledgers and stuff like that. Whatever narrative they have to get you to use their coin, you can have that, and they'll say that the guy on the corner that's selling weed and cocaine, he has a ledger and he wants to do a BTC transaction or a Dogecoin transaction with you. So you better use that Fed coin so we can keep an eye on it and crack down on crime and not fund, terrorism or whatever. Our economy is gauged off of our ability to go into debt, right? So if we, because everybody's like praises like the whole get out of debt and the Dave Ramsey approach and stuff like that. If we did that, everybody, even a large, it's not even everybody, the majority of us, if we did that, the economy would crash. Our economy is gauged by not only our ability, but our willingness to go into debt. If we take away the punishment of making a mistake, what is the incentive to not be reckless? See, if Joe Smo goes and makes a mistake in his business, you go bankrupt, you suffer. You get a loan or whatever, you try and do a debt consolidation, borrow hard money and stuff like that. But overall, you take the L. You have to. But the banks are too big to fail. They're saying that, hey, if you hurt us, you're going to hurt the consumer. So you can't hurt us. You have to help out. And they're like, you're right. We have to help you guys. Otherwise, we're going to hurt the people. So we're not doing it for you. We're doing it for the people. And they're like, yeah, that's right. So, give us the money. And this is what the tone has been for the last 10 plus years. And we keep seeing this aggressiveness, and it's just like in investing. And it's just like, okay, well, if we make a mistake or if we over leverage the money because we have complete control as to how much leverage we want to use on the money. And obviously capitalism says, you drive for maximum profit. What is the incentive to do the right thing or to monitor your risk if you're going to get bailed out? Welcome back to another episode of the Anomalous Investor. So in today's episode, we are going to discuss some very important topics. Everything from Silicon Valley Bank to the banking environment in general. Also, we're going to discuss the Fed rates, kind of where we're going, Fed coin, really just a lot of the catalysts that have come out over the last week, and really what we can expect going forward. The biggest thing that I want to discuss is, starting with Silicon Valley Bank, is this is setting the tone overall for our market. This is giving us the idea of kind of where we stand as an economic threshold, and really how the Fed has responded, but it's typically how they always respond. And the solution to that is to print more money. Ironically enough, that is how we got into the situation anyway. That is why we have record inflation. That is why, if you watch Jerome Powell before Congress, when he was saying that, hey, we need we pretty much need unemployment to go up. We need around another 2 million people to lose their jobs, and that's an unintended consequence of raising rates and getting inflation down. But overall, the numbers are the numbers, and that's what we need. As of right now, the economy is great. We're at historical lows. I think unemployment is like 3.6%. And he was saying that we need it to pretty much raise by another percent, around like 4.5%. And that's going to be around, I think, 1.52 million people roughly. And he was saying that that is pretty much what we need to get inflation down. And how that works really is, when you have an excess amount of money in the economy and you have inflation running wild, it's kind of like what they were saying, that consumer spending was keeping inflation up, and the fact that we had record savings coming out of the pandemic, and that was causing supply chain issues and stuff like that, and that was keeping inflation up. And because of the demand that was on the markets, businesses were raising rates and stuff like that, and that was keeping inflation up. So the way you combat that is you raise the inflation rate, and you're able to kind of remove some of that excess currency that's on the market, be able to get some of that back, reduce rates to borrow, things like auto loans, mortgages, and stuff like that. This is all tied together. This is why you see mortgage rates around 8%. This is why you see credit card rates up. This is why you see auto loans financing rates up. It's all tied together. So when you're able to kind of really just manipulate the currency at will, like the Fed does, you're able to kind of teeter-totter things around, okay, what do we need at this particular time? Do we need rates up? Do we need unemployment up? And ultimately, the fact is that there are about 2 jobs for every 1 person that's working right now. And that is not ideal for an economy that's trying to get inflation down. It sounds bad. It sounded bad when they were getting on to him at Congress, but overall, those are the numbers, and that's what we're going to talk about. Things that you can do personally to make sure that you come on the other side of this. Because yes, it's bad that we have to get inflation down, and the consequence of that is getting unemployment up. But we also have to understand that where unemployment is right now is also a historical low. Now, people losing jobs is not a good thing at all. But when you look at the situation there, it's kind of like twofold. You have the Fed giving the money away. It was made, during the pandemic, COVID crisis, money was falling from the sky, extra money on unemployment, PPP loans, food stamp rates went up. You couldn't be evicted. It was just raining money. And now they're like, we gave all that money out, but now we need to remove some of that money from the currency. So we need some of that money back. And we're going to get that forcefully to get inflation down. So, the other side of that, you have people who are saying, okay, hey, well, look, this is a great time. I've been able to, have record savings. I'm trying to hang on to my money. The rates and stuff keep going up. So I'm working these additional jobs, and they come back and say, hey, we gave all that money, but now we kind of need to squeeze the economy and, put you kind of back to roughly where you were before we gave you the money. So, we give it and we're going to take. So it's really just like a seesaw of emotions, but it's really just a seesaw of the balance sheet of the Fed. And that's what we're going to cover a lot today. And some of the things I think is going to happen even with our Fed coin, Fed crypto, stuff like that, which is starting. The Fed crypto is not starting in July, but we kind of have like that first step to that segue later around mid-year. So we're going to talk about that. And also we're going to get into the talks of Powell specifically for next week. Pivoting to the Fed coin, let's talk about that. We have known about this since we had the bull run. They announced that their investigation into crypto and their big reveal that they're going to do around like 2025, I believe. It's one of like the first videos I made on crypto was called FedCoin, and they're coming for you. I put a picture of like Uncle Sam and stuff pointing. And when we were crossing over the threshold of like the $1 trillion marks and stuff like that, that was I won't say the beginning, but that is something that's always going to catch the eye of the Feds. You see that they want to track what you do in Venmo and PayPal and stuff like that for $600, but we've also seen them misplace trillions of dollars and stuff like that. The Pentagon, but your grandma sends you $600, you're gonna need to report that on your tax return. So we see where the targets are and where they want the money to come from and what exactly they want to pay attention to. And when you have something like crypto that's been growing rapidly, I want to say it took 12 years to get to 1 trillion, 18 months to get to 2 trillion, and I want to say 5 months to get to 3. This is at our peak. We peaked at around the crypto market in totality. Peaked at around $3.3 trillion, right? So at that point, this is like, okay, this is going to cause an issue for the dollar. The dollar, and a lot of times what you're seeing right now, even across the globe in general, is we're witnessing currency wars. And the dollar is the reserve currency of the world. The dollar has to run. It has to move. It has to flow like water. This is the reason that we have inflation in general. So this is saying that, okay, we want inflation at around 2% because we can't have no inflation because otherwise you're not going to be able to manipulate the currency. And you're certainly not going to be able to maintain your status as the reserve currency. So this is why we always have things like real estate that's, if you're over the long term, it's on an upward trajectory. Stock market, over the long term, it's on an upward trajectory. Auto loans, car prices, food, education. These are all areas where that money is dumped. And even outside of it to other countries and stuff like that, you can trade in and out of the dollar before you get into other currencies, like on exchanges and stuff like that. That money has to flow. It has to be attached to something. And coming out of the dollar is a big threat to the overall system. This is why you see things like China and the BRIC legislation between like China, Russia, and potentially Mexico. They're talking about it. This is why this is a big deal, because the amount of money we've printed, again, our GDP is now higher than, our debt is now higher than our GDP. That money coming back to the United States because it's not flowing and stuff like that is another form of inflation. And that kind of global money coming back, that'll send us into hyperinflation. You've seen what just happened when we hand out money via COVID to us. So that money coming back, that's a totally different story. And we're not going to discuss that in this video. But overall, when you talk about the threat of crypto, that is a real threat to that flow system of money that has to kind of always be attached. This is why it's so important that our economy is gauged off of our ability to go into debt, right? So if we, because everybody's like praises like the whole get out of debt and the Dave Ramsey approach and stuff like that. If we did that, everybody, even a large, it's not even everybody, the majority of us, if we did that, the economy would crash. Our economy is gauged by not only our ability, but our willingness to go into debt for years. That is how important that is how much currency we have and how much we have to attach it to actual something, which is labor and time of the retail sector, i.e. us. The ability that we are, a likelihood and the comfort that we have to take on this type of debt is the measuring stick that we use to measure the health of our economy. So if we're not borrowing money for homes, if we're not borrowing money for cars, real estate, education, and medical bills and stuff like that, that is what technically that's textbook definition of a recession. So when you have something like crypto that's coming out and you're saying that, oh, this is a way to get around it, we don't have a participating factor in this market. That's a threat to the overall system. So, and people have asked saying that, okay, do you think that they're going to ban Bitcoin and stuff like that? If they do, it'll be the first of its kind, because typically what happens is, if you look back historically, what happened with gold and silver is first they made it illegal to own it. This was during like the Great Depression. They kind of did like, not illegal, but they did like a claim back and you can redeem it for a fixed amount of dollars. And then they eventually took it off in 1971. Nixon took it off. And now we have like our fiat paper currency. But they didn't say, okay, well, now you can't own gold and silver. They fixed it. If you look on the back of like a gold or silver eagle, a gold eagle will be worth exactly $50. Silver eagle, $1. And yes, it'll be incredibly stupid to trade something that's worth $2,000 or $30 for the actual dollar amount, but that silver amount or gold amount is fixated to the actual dollar. But it didn't say you couldn't own gold and silver. So you can own, those are actual coins because they are minted by the Fed, the U.S. Treasury. But you can get something like gold and silver bullion or gold and silver coins or rounds, and you can still own those, but they have a lower premium and stuff like that, but you can still participate in the market. But the standard that they set is to have like the eagles, both of them are gold or and silver eagles. That is the standard. And the reason for that is they wanted to have participation in the market and to say that, okay, this is less likely for the angle they took. This is less likely for fraud. This is backed by the U.S. government. It has extra protection. It's worldwide, world renowned. In most countries, they have their they have like the Chinese panda, the Austrian Philharmonic, the kookaburra, the Canadian maple leafs. All these nations have their different coins or gold and silver coins that they print by their governments, and this is a way to kind of combat that retaliation of, okay, well, let's just all trade around it so they can have a participation in the market. And I think that's kind of the angle that they're going to have here with crypto. I think they're going to have a participation in the market and really just say that, okay, well, we don't necessarily want to ban crypto, but we're going to have a recommendation that you can use our actual coins. So that is, I won't say it's an attack, but it's not a direct attack to kind of like ban it altogether or something like that. But it is certainly an opportunity for you to participate in the market and also have the government have that control that they want. Because the second thing that they're going to do is persuade businesses to take, obviously, the Fed coin. Because if you say utility, then you'll say that, okay, well, we want something to trade with Bitcoin and Satoshis or Dogecoin and stuff like that. You'll say, okay, well, we want to have utility and be able to trade in and out of that. And the angle that this is going to happen, which is why these scandals and all this kind of stuff kind of gets blown up, because you'll see stuff like, oh, the FTX scandal and, all of these exchanges, they're stealing money and going bankrupt. Meanwhile, there is mass manipulation and mass BS going on in the stock market. But because of the lack of regulation in crypto, they're going to be able to push and say that, see, this is why, A, we need a regulation, which I do agree with, and B, the Fed coin is going to prevent that. And this is something that you can use to kind of trigger businesses to say, hey, you know what? Instead of going with, such and such coin, let's just use the government's coin. It's backed by the U.S. military. And if you do any fraudulent stuff like that, you go to prison and it's less likely to go, bankrupt, or the exchange is going to disappear. Instead of taking X coin, let's make sure that we use that Fed coin. And then boom, the United States is in the crypto market and now the leading issuer of crypto. And then, of course, that will be pushed out on a global scale as well. It's like, hey, look, if you guys are having issues here with BTC and fraudulent stuff, and next thing you know, it'll be crypto is funding terrorism, and all the drug dealers are using crypto and walking around with ledgers and stuff like that. Whatever narrative they have to get you to use their coin, you can have that. And they'll say that, the guy on the corner that's selling weed and cocaine, he has a ledger and he wants to do a BTC transaction or a Dogecoin transaction with you. So you better use that Fed coin so we can keep an eye on it and crack down on crime and not fund, terrorism or whatever. And this will happen on a global scale. That's kind of what I think. I think we're going to see something very similar to what happened with precious metals. So when you combat that, you have to really make sure that if you are supporting your coin, whatever coin you're invested into, whatever utility and stuff that you're looking for, when you have these avenues and stuff like that, make sure that you're being vocal with these businesses. But also when you see certain businesses make the effort to accept crypto and you are holding that crypto, or you want something that's decentralized and not controlled by the government, make sure that you're supporting it. Because often what we're seeing is there's a lot of people saying that, okay, well, we want utility and all that kind of stuff like that. But overall, they're still thinking on a short-term approach, because it's not really about the utility. It's about pretty much making the asset appreciate in value so they can dump it and go back into dollars. And otherwise, you're just defeating the overall purpose. And again, I can't tell you what to do, but I'm just telling you, when you do that, you're jumping right back in and you're going to end up right back in a situation, or, you're kind of just doing exactly what they want, which is so that they can tax you on that and then still have control over the monetary system. So however you want to play it, that's your business. But those are my thoughts as far as for on FedCoin and kind of like the angle and stuff that we can expect to see. Overall, I've been a holder in precious metals for quite some time. I've been buying precious metals, primarily even silver, since I was about 15 years old. You can get things, again, rounds, bars, coins, all that kind of good stuff from a number of sites, or even let your local dealers just kind of make sure you do your due diligence and make sure that you're not buying fake coins or even like those larger bars and stuff, because sometimes they will drill holes in them and fill them with lead or some other BS and use it to kind of manipulate the actual weight, and it'll be off and stuff like that. There's scams and everything. So just kind of make sure you're doing your due diligence. Or you can buy, kind of like literally what I just said, you can buy directly from the government, and you can get your backed by the U.S. government round still coins. And they come in, if you're doing the silver eagles, gold eagles, and stuff like that, you can get them. It depends on how much money you want to spend, but you can get them individually. You can get them in their tubes. You can get them by their monster boxes. I actually have a monster box here. I'll grab it and show you what it looks like. This is a monster box of silver eagles. This one is not full though, but it comes in the lid here. Find it empty to one. So this they come in like a tube like this, and you'll be able to. So I'll just say United States Mint, and it comes in 20 silver. It's a sleeve of 20 silver eagles that comes inside of it. But that's just really for those of you listening to the podcast, you have no idea what I'm showing you, but it's a green box and stuff like that. But you can go into like websites like American Precious Metal Exchange and stuff like that, and you can order them. And it's going to give you diversity. This has been a hedge for inflation for almost forever. And again, this is God's money. This has been around for thousands of years. It's internationally known. It's internationally has value. It cannot and won't go to zero despite whatever currency we're trading. So I do, in my opinion, I do think almost everyone should have some exposure to precious metals. But overall, depending on your financial situation. Obviously that's up to you. But I do think it is very important. So getting into the banking situation. So if we're looking at SVB and a lot of these banking institutions here, we have to point out the fact that we are treading on dangerous grounds, right? When we look at the situation, they say that the banks didn't get bailed out at $250K. They got matched at 100% for the state of the economy. So pretty much the same thing we saw in 2008, too big to fail, bail them out 100%. It's all good. And and at first they were saying that, it's not a bailout. And a lot of people were, even getting on to me saying, oh no, that's not a bailout. It's a bailout. The Fed uses tricky words to kind of manipulate what they're actually doing, but don't be mistaken. It's certainly a bailout, especially when they have low risk and the government takes away 100% of their exposure, and saying that, okay, yeah, you guys made a bad mistake. We're going to cover it 100%. Don't worry about it. Not alone. You have your bonds and stuff like that. Technically speaking, even if you did sell those that could be like collateral. We'll deal with it. We'll square up on the back end. That's a bailout. That's very similar to what happened in the banking crisis in '08. A little different, as in it wasn't directly given to the like in this situation. They're saying that, okay, well, we're not giving it to the bank, where we're giving it to the customers of the bank. Allocation of the funds and stuff like that makes slight difference, but it's still a bailout because the bank's responsibility technically is always the customers, because banks, virtually have no money. They just take other people's money, fractional reserve lending, investing and stuff like that, and able late fees, account fees and stuff like that, and able to generate a profit. But technically speaking, it's always the customer's money. So where you send the check to matters very little difference because we know whose money it actually is. So this sets the tone to say that if we do not get inflation down, or if this triggers another domino and we have higher inflation in another month or so, another 6 months or so, inflation ticks back up, other banks get in trouble, are we going to be, is that the standard, 100% bailout? Because you can't say that, we know that most people don't have the $250,000, over 250,000 like these companies do. But there are large institutions all over the country who do. And even if you have that standard, if this isn't just like Silicon Valley Bank, if it's a Wells Fargo, a JP Morgan, Bank of America, the tone is 100%. Is that the new, is that the tone going forward? Is that work for everybody, or is this a one-time thing? And this can kind of really start a spiral of inflation. This is something that we really have to be careful of, because I'm not saying that people that they shouldn't have let them bail out, but we have to look at what capitalism is and what the cost of making mistakes or bad investments is. If we take away the punishment of making a mistake, what is the incentive to not be reckless? See, if Joe Smo goes and makes a mistake in his business, you go bankrupt, you suffer, you get a loan or whatever, you try and do a debt consolidation, borrow hard money and stuff like that. But overall, you take the L, you have to. But the banks are too big to fail. They're saying that, hey, if you hurt us, you're going to hurt the consumer. So you can't hurt us. You have to help out. And they're like, you're right. We have to help you guys. Otherwise, we're going to hurt the people. So we're not doing it for you. We're doing it for the people. And they're like, yeah, that's right. So, give us the money. And this is what the tone has been for the last 10 plus years. And we keep seeing this aggressiveness, and it's just like in investing. And it's just like, okay, well, if we make a mistake or if we over leverage the money because we have complete control as to how much leverage we want to use on the money. And obviously capitalism says, you drive for maximum profit. What is the incentive to do the right thing or to monitor your risk if you're going to get bailed out? This is, I think, is putting us in a very dangerous situation. This is one of the few times where I agreed with Ken of Citadel when he was saying that, we're watching the destruction of capitalism before our very eyes. And I do think he said that because technically hedge funds could have made some money on this if they were able to lend the bank some money. So I think that was probably a conflict of interest. But overall, what he said was not wrong. But I just think that going forward, we have to have these institutions and stuff be accountable for their actions. You can't say that you can drive maximum profit, and if you make a mistake because of the size of your company, then we have to make you immune to that mistake. That is preposterous, and it's really just going to drive more reckless behavior in the future, and it's not surprising because we've seen this again with our debt, which is basically a runaway train. So I wouldn't be surprised if this keeps snowballing bigger and bigger and bigger. The good news is SVB is not one of the larger institutions in the country. It's the second largest since like Washington Capital and stuff like that. But again, that was almost 20 years ago. So we've inflation-wise and currency-wise over the last 20 years, it's a big difference and it's a different playing field. So yes, number-wise, it's big, but I think that overall, as long as we don't see one of the main branches start to get some instability there, then that should not shake the markets. Overall, if we start talking about like a Bank of America, Wells Fargo, Chase, something like that, yeah, we're in big trouble. We are in astronomical trouble. But overall, outside of that, I think that we're in a great place. So let's talk about this Fed meeting. The Fed meeting we're having next week is going to be very crucial to dictating the next few months, the next quarter, really, and even just setting the tone of the overall market. Because right now we're seeing the market rally, and overall people are saying that, oh my God, this is the bull run. You have to understand, we have when you inject money or do any type of bailout, it has always historically, and I believe it's like 100%, this is always historically resulted in a run in the market. And this is results in green days, these relief rallies and stuff that we've seen because i.e., it's technically just money being injected. So I don't believe this is indicative of the overall tone of the market. So we just have to make sure that we're not having short-sightedness and confusing a micro for a macro. Macro is still going to be these interest rates. Macro is still going to be unemployment numbers. Macro is still going to be the peak interest rates. These are all things that's going to matter and what Jerome Powell is going to talk about next week. What is his forecast for how high we're going to go in peak interest? What is are we going to get the 0.25, 0.50, pause? I'm going to give you the percentages of expectation on those in a moment, but those are going to be the things that determine the next few months and the tone of the overall market. So don't be surprised if you see a pullback in the numbers and the rallies we're seeing here, because that overall is not going to carry us into a bull run when we haven't solved the reason that the market went down in the first place. So right as of right now, we kind of balanced out. Like I said balanced out, but we hit kind of mostly for the most part expectations on CPI over the last month. So the split right now, we are expectation wise, we're 0% are expecting a 0.50 BP rate hike. 75% are expecting a 0.25 rate hike, and 25% are expecting us to pause. So pause, obviously, that would have a continuation on us being green. 0.25 is kind of expected, so typically that means that this is going to be more on the priced in side. But a 0.25 would kind of give you not even kind of, it would certainly give you a continuation of the numbers that we've seen thus far. So if we've seen that, and I think that would signal the bull run, because obviously we have to see where peak inflation is, and we're still at I think we're at like 6% roughly. We have to get down to like 2%, so we still have a gap where we are and where we're headed. But if we get that 0.25, we can certainly see a continuation of the run we've seen over the last month. This is going to be a very crucial point, and for a number of reasons is if we get to a point and we say that, okay, well, the money that we're printing, if we start printing money again, handing out money again, or if we start continuing having banking crisis and stuff like that, we can potentially see a spike later on, because it's never immediate, in inflation. And Powell's, one of the things he said was he didn't want to have to kind of do a pause and come back and say that, okay, or stop and then come back and fire up the BP hikes again. Because essentially what would happen is we would see a situation where they would pause or stop the rate hikes and just kind of say, okay, well, let's see where we are. And then 4 or 5 months from now, inflation starts creeping back up. They're like, oh, we're back again. We're going to have to pull the rug. And so basically you'll have the markets do like this. And he wants to kind of prevent that to the best of his abilities. And this is kind of what we've seen last month before all this banking crisis stuff. He was saying that we may need to raise rates faster and hold them there for longer. So that was his tone prior to the Congress meeting. So it'll certainly be very interesting next week to kind of see where he stands now, as we kind of have an idea of like the banking situations and all that kind of stuff is factored in. But overall, we all have to remember the Fed has very few jobs. Job participation is one, and managing inflation is the other. All that other stuff is not Jerome Powell's problem. It's not his within his factor of control is not what he focuses on. Job participation is one, obviously, so he doesn't want to send us into depression and stuff like that. But also, we can't have inflation out of control where we also just go into a recession and not have people participating or have rates out of whack. So if you it's a very delicate scale to balance. If you have a job, but things are too expensive for you to have market participation, then it kind of defeats the purpose. And if you don't have a job, then you can't compete in any market, and there's zero market participation in the general. So he has to kind of teeter-totter between the employment rate and also the prices of goods, core inflation, all that kind of good stuff like that. So you can kind of have a direct correlation between the amount of people who are actually producing, making money, and their ability to actually participate inside the market. So these are the insights that we're hoping to get next week when he kind of speaks here as we set the tone for Q2 of 2023. So going forward, I think that we kind of need to focus on a few things here. I do believe that outside of investing, trading, real estate, all kinds of good things, we do need to make sure that, especially for the people who have crypto, just even outside these exchanges and stuff like that, I do recommend getting yourself something like a ledger, so that you don't have your coins, your crypto and stuff like that exposed, because an exchange going bankrupt is, if it's not in cash. I know some of these crypto exchanges, they'll say that we have FDIC insurance and stuff like that. That's only on cash. That's only on cash. If you have your coins on there and it's sitting in your account or whatever, and it just disappears or they go bankrupt or whatever, because XYZ or they over leveraged in the area, it's gone. They have, and if you read the TOS in a lot of times, they have no obligation to pay you back. Gemini was habitual for saying stuff like that, like, hey, if your coins are on our exchange, it's basically a loan, and we're not obligated to give it back. So make sure you have things like a ledger or a account that you have a pin phrase for that protects your coins, so that you have them locked in the blockchain, and you can eliminate some of that risk associated with the turmoil that's going on in the market. The accounts overall, I do think that it's always a great time to be invested, but I also think that generating revenue right now, while we have this confusion, and certainly before we have indicative evidence of the next bull run, is going to be ideal. Indexes, I talked about this in my recent video, Never Go Broke Again. Vanguard has a lot of great funds, VU, S&P 500, stuff like that. It's fun to buy it when the bull run and stuff has already started, but overall you can get better prices here and get better returns when you're buying in times of confusion or markets are down. I think these are going to be great starts for a lot of people going forward. And of course, trading. Trading is a little bit more complicated. So there's a series of things that you have to kind of have an understanding of and practice at to be a decent trader. It takes time as well. And so it's not something like a 2-day thing where you're like, oh, okay, I'm a trader now. But if you're proficient at it, you're going to be able to generate money in every market. And of course, that's what we do at Anomalous Investor. But going forward for the community here and the tone of the market, we have a lot of unknowns out there. We have the unknown of where our system quite kind of is, if we're going to have a domino effect with these banks. We have the unknown of if we're going to have a peak back up with inflation, kind of like how they're going to handle it, if they're going to have to do like a Paul Volcker situation and raise inflation higher than our current rates to get inflation down if we have that bump back up. All these things are unknown and on the table. But as investors, it's our job to be prepared for anything. To be generating revenue right now is obviously ideal, but also for the pivot, the turnaround, the bull market, also being able to take consideration of these prices and being able to grow stronger in a recession. You're not going to be able to see the fruits of those labors right now, but those entries and stuff like that, you'll look like a genius on the next bull run. But of course, you need capital for that. And when you have inflation and the original assets that you purchase are possibly down, I understand how it can make you weary about investing or not investing more because you bought too much dip and you ran out of chip. So it puts you in a situation, and that's one of the reasons why I think having that additional cash, whether that's from trading, Ubering, whatever the case may be, and being able to balance out your portfolio long term is going to put you in a better position. And I think that if we have more retailers do that, we'll be in a better situation so that we're not putting ourselves in a position for the institutions and stuff like that to rug pull us and they get bailed out when they make mistakes, or simply on the next bull run or whatever asset that you're investing into, if it's not one of the assets that they've chosen to lead their portfolios, you kind of get shorted into oblivion. So you just always make sure that you're buying quality and making those adjustments overall to balance out your portfolio. So with that being said, make sure you subscribe to the podcast. We're going to be airing every week with some insightful information to bring you the ups, downs, the news that's going on in the market, things that you can do, the tone of the market, and I hope you learned something along the way. I appreciate all you guys. We're on Apple Podcasts, Spotify, all that. And go on there, leave a rating if you're listening to the audio of this. I appreciate all of you, and I will see you in the next episode. Detroit.